Saturday, June 20th. COMEX is closed, the London bullion market is closed, US stock and bond markets are closed. By every normal definition, today is a dead day for silver. Except it isn't, and I'm going to show you exactly which number is moving right now while every exchange screen shows a flat, frozen line, and why what happens in the next 24 hours sets up Monday's entire trading session before a single COMEX trader even logs in. This isn't a vague tease, there's a literal clock running on this, and I'll give you the exact time it matters. Here's something most retail silver investors genuinely don't know, and it's the entire foundation of today's video. Silver futures, traded on CME's electronic platform called Globex, run on a schedule most people have never actually looked at. The official trading window is Sunday at 5 p.m. Central Time through Friday at 4 p.m. Central Time. That's 6 p.m. Eastern Sunday to 5 p.m. Eastern Friday. With one short maintenance break each day between roughly 5 and 6 p.m. Central, this market is functionally open almost 24 hours a day, 5 days a week. What that means in plain terms, silver futures trading does not restart Monday morning when most people check their phones and see the first price update. It restarts tomorrow evening, Sunday evening. Right now, as I'm recording this Saturday, we are approximately 24 to 30 hours away from the first new silver futures price print since Friday afternoon's close. So when I say in this video's title, "This number still moved," I mean it literally and precisely. There is a scheduled, publicly known moment tomorrow evening at 6 p.m. Eastern where the first new tick of silver pricing happens on CME Globex, and it happens a full 12 to 13 hours before the New York stock market even opens Monday morning. Most mainstream coverage of silver completely ignores this. They treat Saturday and Sunday as a blank void in time where nothing happens, and then they act surprised when Monday's opening price already reflects a significant move that nobody saw coming over the weekend. It didn't come out of nowhere. It came from the Sunday evening futures reopen, a trading session that almost nobody outside of professional futures desks actively watches or participates in. Here's the mechanism that makes this actually matter for your portfolio and your decision-making, not just interesting trivia for futures market nerds. When a market closes Friday afternoon and doesn't reopen until Sunday evening, anything that happens in the news during that closed window, geopolitical headlines, central bank commentary, economic data releases from Asia or Europe that come out over the weekend, has nowhere to get priced into the market. It just sits there, building up pressure, with nowhere for that information to flow into actual price discovery. Then Sunday evening hits, 6 p.m. Eastern. The CME Globex order books open for silver futures, and all of that pent-up news and information that accumulated over 48 hours hits the price at once, condensed into a single reopening moment in what's almost always a thin, low-volume trading session. Why is it thin and low volume? Because far fewer traders are actually sitting at their desks, logged into their trading terminals, actively monitoring silver futures at 6 p.m. Eastern on a Sunday evening, compared to, say, 10 a.m. on a Tuesday morning. It's the weekend. Most people aren't working. Professional trading desks are often running with skeleton crews. Retail traders are with their families or doing literally anything other than watching commodity futures reopen. The result of this combination, accumulated news plus thin liquidity, is something futures traders call a gap. Sunday's opening price can be meaningfully different from Friday's closing price, sometimes jumping up or dropping down in a way that looks visually dramatic on a candlestick chart, purely because of this weekend information backlog releasing all at once into a market that has very few active participants online to absorb it smoothly. This thin liquidity, widespread Sunday session behavior is documented and well known among professional futures traders. It's specifically flagged in CME's own market education materials as a higher risk trading window because of reduced liquidity and potentially wider bid-ask spreads. And it's exactly why some professional trading desks treat the Sunday evening reopen with extra caution and tighter risk controls. The same size order that would barely move the market on a Tuesday afternoon can move it noticeably, sometimes violently, at 5 or 6 p.m. Central on a Sunday. So here's your actual practical takeaway, not just an interesting market structure fact. Whatever headline drops between now and tomorrow evening at 6 p.m. Eastern, anything significant out of Asian markets, anything geopolitical, any surprise economic data print from Europe or the Middle East, gets its first real price reaction not Monday morning when you check your phone, but Sunday night at 6 p.m. Eastern, in a thin session that most retail investors aren't even aware exists. Now let's talk about exactly what's sitting there right now, loaded and waiting for that Sunday reopen to react to it. This week's Federal Reserve meeting on Wednesday revealed something specific and significant. 9 of the Fed's 19 voting policymakers now project at least one interest rate hike before the end of this calendar year. As of Friday's market close, futures markets were pricing roughly a 70% probability of an actual rate hike happening by September based on CME FedWatch tool data. Let me repeat that fraction because it's important. 9 out of 19 total voting members. That is not a fringe minority of hawks anymore. That's nearly half the entire Federal Open Market Committee now leaning toward the view that policy needs to tighten further from current levels, at a time when just a few months ago, rate cuts were the dominant expectation across most of the committee. Here's why this matters specifically for tomorrow night's Sunday reopen, not just as general background context. The market has had Friday afternoon and all day Saturday to sit with that 9 out of 19 hawkish split number from Wednesday's meeting. But futures traders haven't been able to act on it yet in the silver market because that market has been closed since 5 p.m. Eastern Friday. Every professional trader, every algorithmic system, every hedge fund that wants to adjust their silver futures position based on fully digesting and modeling this Fed committee shift has been sitting on their hands for 48 hours, unable to execute. That backed-up reaction pressure doesn't just disappear or evaporate. It gets released the moment trading authority reopens. Sunday evening at 6 p.m. Eastern becomes the first real opportunity for the silver futures market to fully price in a week's worth of Federal Reserve policy repositioning, all at once, compressed into a single reopening session that historically has lower participation and wider spreads than a normal weekday afternoon. This is the literal, mechanical reason behind this video's title. The number, silver's quoted price, hasn't updated since Friday at 5 p.m. because the exchange has been administratively shut. But the fundamental inputs that silver's price reacts to, Fed policy signals, interest rate expectations, inflation data, geopolitical risk, those inputs have kept accumulating and evolving all weekend long. The moment the CME Globex gate opens tomorrow at 6 p.m., that entire backlog of information and repositioning pressure hits the market simultaneously. Here's a second number worth watching very closely at that Sunday reopen, and it's one that almost nobody tracks properly because it requires comparing 2 different prices instead of just watching one metal's spot quote. The gold to silver ratio. This measures how many ounces of silver it takes to equal the value of 1 ounce of gold. When gold is at $4,000 and silver is at $65, the ratio is roughly 61.5 to 1. That ratio compressed from around 64 down towards 61 over a roughly 2-week stretch in mid-June, as silver was outperforming gold on a relative basis. Compression in this ratio is historically a silver bullish signal, because it means silver is gaining value faster than gold, which typically happens when industrial demand or supply tightness concerns are dominating the narrative. But by Friday's close this week, that ratio had bounced back up to roughly 64.8. In just a matter of days, the trend completely reversed. Silver went from leading gold higher during the mid-June rally to lagging gold lower during this week's Fed-driven sell-off. Why does watching this ratio matter more than just watching silver's outright price in isolation? Because a ratio that's whipsawing this hard, this fast, compressing from 64 to 61, then re-widening back to nearly 65 in a span of 10 trading days, tells you the market fundamentally hasn't actually decided on a clear consensus directional story yet. It's not calmly trending in one direction with conviction. It's violently oscillating between 2 competing narratives. Narrative 1. Silver outperforms because physical supply is genuinely tight and industrial demand is structural. Narrative 2. Silver underperforms because rising dollar strength and rate hike fears create monetary headwinds that matter more than supply fundamentals. Neither story has fully won yet. They're fighting for dominance in real time, which is exactly what produces this kind of ratio whipsaw behavior. When that gold-silver ratio reopens tomorrow night alongside silver's outright price, watch which direction it moves first and with what kind of momentum. If silver's price falls on the Sunday reopen, but the ratio simultaneously keeps climbing, meaning gold is holding up even better than silver in relative terms, that tells you the dollar and rates bearish story is still the dominant force in the market. Money is flowing toward gold as the safer monetary hedge, while silver gets sold as the higher risk industrial commodity.
But if silver's price falls on the Sunday reopen, and yet the ratio starts compressing again, meaning silver is actually falling less than gold, or stabilizing faster, that tells you physical supply-side silver buyers are stepping back in to accumulate even during a soft tape. Same headline price move on your screen, two completely different underlying market dynamics and stories. And watching the gold-silver ratio is what allows you to separate and distinguish between them. There's one more timing detail that connects directly to why this specific weekend setup matters more than a typical weekend reopen, and almost nobody has mentioned it in mainstream silver coverage.
Friday, June 19th. The most recent trading session before today was Juneteenth, a U.S. federal holiday. U.S. cash equity markets and bond markets were closed that entire day. Silver futures remained open on Globex because CME commodity markets don't observe the same holiday calendar as stock exchanges, but participation was significantly reduced.
What that means is that Friday's silver trading happened in what market participants and CME commentary specifically describe as thin holiday trading conditions. Thin holiday sessions behave structurally differently than normal full participation sessions. Lower overall participation means individual trades carry disproportionately more weight in moving the market. Price moves can look more dramatic on a percentage basis than they would be on a normal Tuesday with full liquidity. And critically, the closing price going into the weekend may not fully represent where a fully staffed, normally liquid trading environment would have actually settled the market. So here's the compounding, layered situation heading into tomorrow night's Sunday reopen. Friday's close was already a thin, holiday-distorted price print that may not represent normal market equilibrium. Then, markets sat completely shut all day Saturday and most of Sunday. Then, trading resumes tomorrow evening at 6 p.m. Eastern in what is historically itself a lower liquidity session compared to a normal weekday afternoon. That's two consecutive low liquidity, thin participation windows stacked directly back to back, with a real, significant, market-moving Federal Reserve policy shift sitting unresolved in between them. This is precisely the kind of setup that produces outsized, exaggerated price moves, not because the fundamental story changed dramatically, but simply because there hasn't been a normal, fully liquid, fully staffed trading session yet to properly digest and smoothly price in the news. So, practically and tactically, here's exactly how to use all the information I just walked through. First, mark 6 p.m. Eastern tomorrow, Sunday, June 21st, on your calendar or set an alert on your phone. That's the actual precise moment when new silver pricing information starts flowing into the market, not Monday morning. If you're the type of investor who checks silver prices once per day in the morning, and you check Monday morning, you're already seeing a reaction that's 12 hours old. You're seeing the result, not watching the cause unfold. Second, when that Sunday reopen happens tomorrow at 6 p.m., don't just look at the price number itself. Look at the bid-ask spread, the gap between the price someone is willing to pay to buy versus the price someone is asking to sell. A wider than normal spread confirms you're in exactly the kind of thin, low liquidity session I just described, and a wide spread is a leading signal to expect more price volatility, not less, in the hours and sessions that follow as more participants gradually come online and normal liquidity returns to the market. Third, watch the gold-silver ratio movement alongside silver's outright price, not instead of it. Don't ignore the price, but add the ratio as a second data point. The ratio tells you which underlying story, dollar strength and rate fears versus physical supply tightness, is currently winning the tug of war. And that story matters more for predicting next week's sustained direction than any single Sunday night price tick in isolation. And fourth, and this is the most important practical point, don't treat a thin session, Sunday evening price move as a confirmed new trend signal by itself. Sunday's reopen price is real. It's not fake. It's not irrelevant. But it's also not the final market verdict. Wait to see how Monday's full volume trading session, with normal institutional participation and normal liquidity conditions, either confirms and extends whatever happened Sunday night, or reverses it as an overreaction to thin conditions. Thin sessions are real and absolutely worth watching closely, but they're not the final answer. They're the opening bid in a negotiation that gets settled when full liquidity returns.
Quick recap for Saturday, June 20th, 2026.
Silver closed Friday around $64 to $65 per ounce in what was explicitly a thin, Juneteenth-holiday-distorted trading session. Markets are completely shut today, Saturday, but silver futures trading on CME Globex reopens tomorrow evening, Sunday, at exactly 6 p.m. Eastern Time. And a full weekend's worth of undigested Federal Reserve policy repricing, that 9 out of 19 member hawkish split signaling potential rate hikes, gets its first real opportunity to actually move silver prices in that Sunday reopen session. Watch the gap between Friday's close and Sunday's opening print. Watch the bid-ask spread width when that market opens. Watch the gold-silver ratio movement alongside the outright silver price. That combination of data points is where Monday's entire trading session actually begins, not when the opening bell rings in New York 12 hours later.
Tomorrow evening, once that Sunday reopen actually happens and we have real price data, I'll be back with a follow-up video showing you exactly what that first new print looked like, how wide the spreads were, what the ratio did, and what all of it is telling us heading into the full trading week. Subscribe to this channel, hit the notification bell, and I'll catch you right after that 6 p.m. Eastern Sunday reopen with the actual data. John A.G. Investor, Saturday, June 20th, 2026.